It always begins the same way, not with panic, not with chaos, but with a quiet, irresistible sense of confidence. When the world is calm, when markets rise every week, when people say, "This time is different," that's exactly when the next financial crash is already being written. Because every major collapse in modern history, from the Great Depression to 2008 to the crypto implosions of the 2020s, follows one eerie, repeating pattern. A pattern driven not by numbers, but by human nature. And once you see the pattern, you start to realize something chilling. Crashes are not accidents, they're consequences. The origins of the cycle. To understand why the pattern repeats, we need to go back to the early days of modern capitalism. In the 19th century, financial markets were expanding rapidly. Railroads, steel, coal, global trade, every breakthrough created fortunes. But it also created something else, speculation. People started betting on what might happen, instead of what was happening. Governments noticed it again and again. Economic booms were growing faster, and so were the crashes that followed them. But no matter how destructive the downturns became, one truth remained unchanged: the boom always comes first. Because humans are wired to chase profit. And when profit looks easy, risk becomes invisible. The rise, the illusion, the breaking point. Every crash begins with a rise, a steady climb that looks safe, logical, inevitable. Then comes the illusion. People start believing prices will always go up. Banks loosen lending. Investors take on debt. Consumers spend money they don't have. The system inflates quietly, like a balloon filling with air. At first, nothing feels dangerous. Markets look stable. Corporations look strong. And anyone who warns about risk is laughed at. But underneath, something is happening. Risk is silently concentrating in one corner of the economy: real estate, stocks, tech, crypto, or banks. And the pressure keeps building, because everyone believes someone else will pull back first. Yet nobody ever does. The trigger everyone missed. Then, a single event, usually small, breaks the illusion. In 1929, it was declining confidence in overvalued stocks. In 2008, it was subprime mortgages starting to default. In 2020, it was a global shutdown exposing fragile supply chains. In crypto markets, it was overleveraged platforms collapsing one by one. The trigger is never the real cause. It's just the spark that exposes how unstable everything already was. And once that spark hits, the pattern accelerates. The panic phase. Investors rush to sell. Markets fall faster than anyone believed possible. Financial institutions tighten credit. Debt becomes unpayable. Businesses collapse. Ordinary people lose savings, homes, jobs. Confidence, the invisible fuel of the entire financial system, evaporates. A crash is not just an economic event. It's a psychological chain reaction. When fear takes over, even healthy assets get sold. Even stable companies shrink. Even strong banks face pressure. The system that once felt unstoppable suddenly looks fragile. And for a moment, everything freezes. The government intervention. Then comes the predictable next step: rescue. Central banks cut interest rates. Governments inject money into failing institutions. Regulators tighten rules. Stimulus packages flow into the economy. Sometimes these actions save the system. Sometimes they delay the reckoning. Sometimes they create the foundation for the next bubble. But one thing is always true: governments react after the damage is visible, never before. Because no politician wants to stop a booming economy. No leader wants to be the one who slows down growth. And no voter wants to hear warnings when money is flowing. Intervention brings stability, but also plants the seeds for the next cycle. Why the pattern always repeats. The reason every financial crash looks the same isn't mathematical, it's human. People are optimistic in good times. They underestimate risk. They follow crowds. They chase quick returns. They believe stories more than statistics. And financial markets magnify those emotions. Fear becomes contagious. Greed becomes addictive. Technology changes. Industries change. Governments change. But human nature doesn't. The cause of every crash is different. The pattern is always the same. The modern world is not immune. Today, the global economy is more connected than ever. A crisis in one country can ripple across the world in hours. A rumor can move billions of dollars. A social media post can trigger a bank run. Housing markets, stock markets, crypto assets, government debt, they're all bigger, faster, and more complex than any time in history. Which means the next crash won't be an anomaly. It will be part of a cycle older than modern finance itself. The only unknowns are where, and when. Reflection. In the end, financial crashes are not failures of the system. They are reflections of us. Our ambitions. Our fears. Our desire to believe in simple stories during complicated times. The real lesson is not how to predict crashes, but how to survive them. How to recognize the signs earlier. How to stay grounded when the world isn't. And how to remember one simple truth: if a boom feels too perfect to question, it's usually on the edge of breaking.